Well, good morning and welcome to the Reserve Bank. With me I've got John McDermott, who's the bank's Chief Economist and Assistant Governor, and also Willie Chetwin, who's the Head of Forecasting. The Reserve Bank today reduced the official cash rate by 25 basis points to 3.25%. Growth in the global economy remains moderate, but volatility in financial markets has increased. The New Zealand economy is growing at an annual rate of around 3%, supported by low interest rates, high net migration and construction activity, and the decline in fuel prices. However, the fall in export commodity prices that began in mid-2014 is proving more pronounced. The weaker prospects for dairy prices and the recent increases in petrol prices will slow income and demand growth and increase the risk that the return of inflation to the midpoint would be delayed. Inflation has been low due to falling import prices and the strong growth in the economy's supply potential. Wage inflation and inflation expectations have been subdued. With the fall in commodity prices and the expected weakening in demand, the exchange rate has declined from its recent peak in April, but remains overvalued. A further significant downward adjustment in the exchange rate is justified. In light of the forecast deterioration in the current account balance, such an exchange rate adjustment is needed to put New Zealand's net external position on a more sustainable path. A reduction in the official cash rate is appropriate given low inflationary pressures and the expected weakening in demand, and to ensure that medium-term inflation converges towards the middle of the target range. We expect further easing may be appropriate. This will depend on the emerging data. So thanks very much. Auckland house prices are running at 17% in terms of house price inflation, whereas the rest of New Zealand is house price inflation's around 3%. So the housing situation in New Zealand, from an economic perspective, is very much an Auckland problem. And we've got the median house price in Auckland up 60% since where it was at the end of 2007. That's true for the median house price. You look at indicators such as house price to disposable income ratios, they're around 7.5, and yet they're 4 in the rest of the country. So we have been concerned, as you know, about Auckland house prices.
Are we looking at the next available opportunity for a cut, or will it be at some stage over the next 6 months?
Well, I think that really will depend on the data. When we're looking, one of the issues was, given that we were forecasting an interest rate track of 2 cuts, one of the issues was, when do you start that process? Having indicated that your projections assume 2 cuts are built in. We felt that we needed to start that process today because of the various things I've talked about, the terms of trade adjustment, the difference in assumptions since March, what's happened on the petrol prices. You've seen inflation expectations and other inflation indicators quite moderate. So we're sort of looking out the next 12 to 18 months in terms of monetary policy. We're seeing that demand will probably decelerate over that period in terms of its rate of growth. So that, we felt that if we delay, we may well end up with a case where we had to be more aggressive further down the track.